Changes in interest rates set by the central bank do have an effect on the value of your bond. In today's video, I'm continuing looking at the risks that your bond faces, and I'm focusing entirely on interest rate risk. If you have subscribed to my channel already, a million thank yous to you for subscribing. If you haven't subscribed, now is the time for you to subscribe to my channel by clicking the subscribe button. It's at the bottom, it's down here. And also don't forget to smash the bell icon so that every time I release a video, you'll get an instant reminder. Now, let's get started. Hello there, entrepreneurs, and welcome to another episode of the Ndalama Insights Business Show with Mukonkela, where we turn your challenges into actionable insights. Now today, I'm looking at interest rate risks on your bond investment. When we talk about interest rate risk, we are talking about the fact that interest rates change depending on the monetary policy implemented by the government. And the organ that is responsible for monetary policies in any country is the central bank. For Zambia, it is the Bank of Zambia. So when the Bank of Zambia reviews their best lending rate or BOZ policy rate, it also affects the cost of goods and services generally on the market. And this also includes the value of your investment in the bond. Now, for those of us that have invested in a government bond and do not desire to sell it until the bond matures, we are not really exposed to this interest rate risk, because at maturity of the bond, we are going to get our full face value amount, and we will be getting our biannual coupon incomes. As a result, it can be said that we are protected from this risk of interest rate changes because we are holding on to maturity of this bond. Now, if you intend to sell your bond on the secondary market, in Zambia, our secondary market is the Lusaka Stock Exchange, you need to keep a close eye on the interest rate, because the changes in the interest rate affect the price for the bond that you've invested in. Why would you want to sell your bond? Why wouldn't you just hold on to it until it matures so that you are protected against the interest rate risk? It's a good thought, but sometimes you might want to receive money ahead of the maturity date. You might have received an emergency, or you're just in dire need of cash right now, and the best option you have for yourself is to sell off that investment in the bond. Other times, especially if you are a well-informed investor, you've already done your maths and you've concluded that this investment in the bond is not giving you the return on the investment that you need or that you desire, and maybe you've got better investment options that you'd want to consider, then you can sell that investment in your bond on the secondary market. And that way you are able to reclaim your cash back before the maturity date. And so these two are some of the reasons why investors dispose of their investment in the bond on the secondary market. So if you intend to sell your investment in the bond on the secondary market, you do need to be aware of the risk of interest rate on your investment in that bond. Now, let's go back to our previous example in order for us to understand the interest rate risk on your bond investment. One thing I would like you to take note of is that when you invest in a bond and the central government has revised the best lending rate, okay, which is affected by so many factors such as inflation, the general economic performance, the general, growth of the economy, and generally where the government of the country wants to take the economy to. All these factors affect the base lending rate of a country. So where the base lending rate in a country has been revised upwards, we expect that the cost for goods and services generally are also going to go up. Okay, things become more expensive. For example, if the best lending rate or the interest rate is increased upwards, we expect borrowing maybe from a commercial bank to also go up. It happens automatically, doesn't it? So that risk also applies to your investment in the bond. Let's take a look at interest rate risk from a corporate bond perspective in order for us to really understand interest rate risk. Assuming that you had invested in a corporate bond, okay, which is a bond that a company issues rather than the government. So instead of a government bond which a government issues, in this case a corporate bond, the issuer is a corporate or a company. That is why it's referred to as a corporate bond. Assuming you've bought a corporate bond, okay, or you've invested in a corporate bond, and then interest rates go up, okay. Maybe you invested in a corporate bond at 10% interest rate, and then the best lending rate, central bank has revised it upwards, maybe by a percentage such that generally all the interest rates on the market have gone up. I'm talking about bank lending rates. Now you are holding on to this corporate bond which is valued at an interest rate of 10%. What will happen to the new bonds that this company is going to issue? Are they still going to be issued at 10%? Very unlikely. What is likely to happen is that the new corporate bonds are going to be issued at a higher interest rate, meaning that your bond has lost value. In other words, the price for your bond will have to come down in order to match the return on the investment on the bond that you'll have made. So because the lending rate has gone up, it will result in the price of your bond also coming down. Okay, because no one will want to buy your bond at the current price or the price that you bought it for. Okay, so in order for you to even stand a chance of selling that bond, you will have to reduce the price. And that is the effect of changes of interest rates on bonds. Now, in order for us to understand the effect of interest rates on the Zambian government bonds, it's essential that we look at the results for the bonds. And I took a look at results for the bonds over different years: 2016, 2019, 2022. In fact, in 2022, I looked at 2 months. I looked at March 2022 and August 2022. What you notice when you look at the results for the bond for March 2022 is that the cutoff yield rate in March 2022 was 22.25%. And the cutoff price was 67.04. The coupon rate was 11%. If you go to August 2022 results, for the same 5-year bond, you are going to find that the cutoff yield rate is 24%. It went up in August, resulting in the drop of the bid price or price of the bond to 65.5126. The coupon rate remains the same. Now, what I get from this is that when the yield rates are going up, the price is coming down. The price of the bond is coming down. Inversely, we can say that when the yield rate is coming down, the price of the bond should go up. There are a number of factors that affect the yield rate on a bond. Other than the interest rate which we are looking at today, inflation also affects the yield rate. Also, the general economic performance of the country affects the yield rate in that country. Now, Zambia is really an interesting case, because when I searched the best lending rates for Zambia for the previous few months, starting from January, I noticed that the best lending rate has been constant. It's been at 9% for a number of months now. In fact, since March, the best lending rate has been at 9%. The coupon rate as well for a 5-year bond. In fact, if you look at many other bonds, the coupon rate has been fixed. For a 5-year bond, it's been 11% for so many years now. Now, if we look at how interest rates affect the bond, especially if you go back to the example that I gave in terms of the corporate bond, you can actually grasp the real effect of interest rate risk on a bond. Let's go back to the example that we've been looking at in my previous videos and see the effect of change in the interest rates on the government bond. Okay, so when you take a look at the previous example that we had considered, I've included some extra rows. I've included the NPER, which is the number of periods for the bond. In this case, we have 5 years, okay? And I'm looking at the March 2022 bond as well as the August 2022 bond. All right, the coupon rates are the same. The cutoff prices are different, okay? Remember, the August 2022 yield rate is more. As a result, the cutoff price is low. It's got an inverse relationship. The March 2022 cutoff price is 67.046. The August 2022 cutoff price is 65.126. The nominal price is 100 kwacha, doesn't change. The number of periods is 5. Now, if you look at the coupon incomes, they are fixed. This is why bonds are referred to as fixed income investments. The coupon income is fixed, it's the same. And then the interest income is different. This is because of the price of the bond. Okay? The August bond is selling at a lower price compared to the March bond. So we find that the interest income is higher, okay, naturally, because I'm buying it at a lower price, so I expect to make much more income than the March bond. Okay, now if we come down here, I've done some computations for the yield rate and the yield to maturity. If you haven't watched the video where I define what yield rate and yield to maturity are, watch this video right here to learn more about what yield rate and yield to maturity is. So the yield rate is more like the return on the investment of a bond, okay? And the yield rate is computed with a very simple formula. Okay, and that is yield is equal to coupon amount over price. That is the yield rate. So if you look at the coupon amount, which is 5,500 divided by the amount, which is 33, it gives you the yield rate of 16. So those are the two numbers that are making up the yield rate. So it's the coupon, it's the annual coupon income divided by the price of the bond. That gives you your yield rate. So for March 2022, the yield rate on a 50,000 kwacha bond investment is 16.41. The yield rate for the August 2022 50,000 kwacha bond investment is 16.79. So the August 2022 bond investment has a higher yield compared to the March 2022 bond investment. However, very interesting is that upon maturity, of course, you get the face value back. All right. Now look at the difference here. The interest income is 17,000. The cost is 32, giving both bonds the same face value return. The yield rate, which you can get as a formula in Excel, you simply need to type in rate, okay, and then you put the number of periods For example, for this March investment, number of periods is 5, okay, comma, the monthly payment, which is the coupon rate, comma, present value is your investment in the bond, so it's a negative, the investment in the bond, which is, in our example here, 33, let me pick the one up here, comma, the future value, which is how much you expect to get in return, 50,000, enter, gives you the yield to maturity rate. If we copy this formula across to the to August 2022, we get the same yield to maturity. Now, if we go back to the definition of the interest rate risk on a bond, we've said that generally when interest rates go up, we expect new bonds to be issued, at higher interest rates, because no one is going to buy the same bond with the same interest rate or coupon rate. Okay. So, assuming this was a corporate bond, not a government bond, what would normally happen is that when interest rates go up, the base lending rate, central bank has increased the base lending rate to whatever percentage, we expect that the new bond, okay, assuming that this August new bond is issued, we don't expect the coupon rate to be 11%. We expect it to go up to reflect the increase in the interest rates. So let's assume that this new bond is issued at 12%. Okay, this will change all the metrics here, as you can see. But most importantly, it's going to change the yield rate as well as the yield to maturity rates. So if you are, an investor in a bond, in the March 2022 bond, your bond has lost its value because the yield rate remains at 16.41%. The yield to maturity is 23%. In order for you to be able to sell that bond on the secondary market, you will need to reduce the price of your bond so that you can match, what is generally happening on the market. That is the risk that you are faced with when you invest in a bond. Now, it is really strange with the Zambian government bonds. The coupon rates are fixed regardless of the changes in the interest rates, though the yield rates are changing. As you've seen from the March 2022 bond results compared to the August 2022 bond results on a 5-year bond, you see that the yield rates have changed. The coupon rates have remained the same. Though the general concept in terms of interest rate risk on a bond is that when the central bank increases the base lending rate, we expect new bonds to be issued at higher interest rates, resulting in the bond that you're currently holding losing its value. Okay, as a result, you will have to reduce the price of your bond in order for you to stand a chance to sell it on the secondary market. Now, having said all of this, when we look at our secondary market, which is the Lusaka Stock Exchange, there's very little information on the prices for bonds on the Luse. And I'm pretty sure government is aware of this. I hope they've got plans to, ensure that the secondary market is really active, and we've got information. We're actually receiving information on the performance of the bond. So if you are an individual that would love to sell a bond on the secondary market in Zambia right now, the best option you have is to contact Bank of Zambia directly themselves, or go to any commercial bank that trades in bonds. Many do. In fact, majority commercial banks actually trade more in treasury bills. And, so you will be able to find out a lot more information from the commercial banks as well as Bank of Zambia in terms of what the current price for a bond is or is likely to be. I think they've got much more information in terms of, market data on the value of of the bonds on the secondary market. You may also contact Lusaka Stock Exchange. Them being the secondary market should have information on the prices for bonds. Well, this is all I had to share in today's video. If you've got further insights that you'd like to add on to this video, please do so by dropping your comment in the comment section down here. And also, if you've got a question, there's something that you're not really sure about, don't forget to drop that question in the comment section below. And if you've subscribed already, a million thank yous to you for subscribing to my channel. If you've been watching my videos for a number of times now and you still haven't subscribed to my channel, consider subscribing by clicking the subscribe button. It's up here. And also don't forget to smash the bell icon so that you can be reminded every time I release a video. Thank you so much for watching and see you next time.